Diane, the wage growth is getting the lion's share of attention. How concerning is it?
It is certainly worrisome, although it's important to note that wages were accelerating at this point in time last year. So the year-on-year comps get harder to make right through the beginning of 2020 because of that acceleration we saw at late in 2018 and early 2019. That's something that the Fed will take with a bit of a grain of salt, but it is something the Fed is going to be watching the closest, because an economy that delivers jobs but doesn't deliver wage gains is not what they want. They want some heat in wage gains, and we're still seeing wage gains not really pick up at the pace we'd like to see them, especially given the low level of unemployment.
Diane, as you're talking, Dow 29,000 for the very first time, coming after Dow 28,000 back in November. Very quick turn of another 1,000-point milestone. And David and Court, we'll just use this as another flag post in the ongoing market rally that has lasted for a decade plus.
Yeah, it's pretty unbelievable, the run that we've had here. And really, technology just continues to lead the way with a lot of these big momentum names. Names like Apple and Microsoft, Facebook continuing to gain some steam here. Technology is the strongest group of the S&P sectors, again, as we hit Dow 29,000.
Yeah, well, percentage-wise, of course, as we all know, it doesn't take much to go up thousands from here. It's a lot different than when we were at 5,000 or 6,000. Certainly, and we made a lot more of those milestones. The S&P, though, up another 1.6% so far year to date, led by the largest companies, Apple, Facebook, and Alphabet.
Yeah. Dow components that have performed best since that last 1,000-point signpost. Apple, up 16 plus. Goldman, UNH, Nike, Microsoft, McDonald's. The laggards would include names like Boeing, Depot, and Walgreens Boots Alliance. So interesting to look at the internals and what has contributed to this latest milestone, as we said, at Dow 29K. Omar, David mentions a nice start to the year. I know Stock Traders Almanac would say you get the S&P up for the within the first 5 sessions. Tends to say good things about the year in total. What's your view right now?
Well, I think, we just see a continuation of the great rally we had, last year, and a lot of, the strength that we have seen in the economy seems to be well portrayed in the market. I think if you compare, the beginning of this year when what we had a year ago, most of the risk that we had a year ago of potential higher rates, a trade deal that was not there, a significant amount of deceleration of earnings that was priced in, we almost see the opposite as we begin this year. So where we see at least the beginning of a phase 1 trade deal with China, we see that the economy continues to be well supported by, the labor market as well as by a very strong consumer. And we don't necessarily see that, earnings are actually going to continue to go down. And in fact, expectations are that earnings, will potentially pick up in 2020. So when you look at the picture, it's not very surprising that we see a continuation of that. I do think what is surprising is that we see the level of volatility not going higher despite all the geopolitical headlines that we have had lately.
Omar, as we look at some of the data from Lipper, we're seeing an awful lot of inflows into some of these taxable bond funds, including the taxable bond ETFs. Is that an area that looks attractive to you now? We've spoken a bit about broader equities, but when you're looking at a taxable bond fund, something you're interested in?
Well, I think in general, investors always, look at taxes, and particularly as we go through this season with so much in capital gains that have been, gone through the last decade, the opportunity to have investments where you can actually, have a better, more efficient, and I would actually even say that includes some, ETFs that are very efficient in terms of taxes. That's an area that we always, suggest for our clients to look at. So being efficient on taxes, low cost, low tracking errors, that's always an area that should be benefit, especially when you see these large gains that we have seen over the last decade.
Diane, some of the commentary out of the Fed officials yesterday was interesting. Kaplan saying that he's thinking at least about the increase in the balance sheet and the degree to which that creates imbalances and valuations of risk assets. Bullard saying bring it on when referring to welcoming inflation, letting it run above target. I mean, what does asset inflation in equities and the lack of increasing wage growth and jobs mean at the Fed right now?
This is a really good, this is at the heart of their debate within the Fed is, are they stoking additional bubbles by the pivot they did last year in cutting rates, taking back 3/4 of what they took in terms of rate hikes in 2018 and 2019, and that helping the stock market most directly. Also important for the Fed is the delineation between the stock market indices and the broader economy. 100 companies counted for 50% of profits back in the 1970s. Now only 30 major companies of the largest, most profitable companies account for 50% of the profits today. So the stock market is even less reflective of the overall economy. So there is a bias in the broader stock market indices that it's not really reflecting the economy and profits in the broader economy as much as it had in the past. And I think that's really important too. But clearly that's where the tension is, do we risk stoking stock market bubbles and asset price bubbles instead of broader inflation as the Fed cuts rates? And so far, we've seen almost all of the Fed stimulus show up in things like asset prices. We have seen, though, also the spillover effect to housing, which is really important going forward. That's a sector that had been dormant, and we are starting to see the housing market come back. Unfortunately, not enough in construction activity to alleviate the pressure on prices there. The one place inflation has been a problem. We want it more broad-based, where wages are actually picking up more generally.
Yeah. One last point, Omar, to Diane's point about how much the market reflects the economy. I mean, how does that explain, how much of it explains the lack of small caps' ability to keep pace with large cap equities?
Well, I think that's a really great point, and it's certainly the case in a market that continues to go up, because of the construction of the indices. You tend to have a high level of concentrations in the mega caps that constitute a significant portion of those indices. I certainly agree that that's not necessarily a reflection of the overall economy, but I think the levels of the market and the lack of volatility does have a good reflection on where we are economically, and the fact that, mega caps and large cap companies also reflect the fact of where we are in the cycle. It is very natural for the cycle where large caps outperform small caps, because of where we are in the last phases of the cycle. So I think in a way that is very consistent, even though, a 30% return like what we had last year is clearly not a reflection of how, growth of the economy will actually be. Now, that being said, obviously small caps, always represent a very good opportunity, especially when you have a credit market that is actually pretty accommodative. So I think, that gap between large cap and small cap, actually will potentially be reduced as we continue to go in through the last phase of the market economic cycle.